Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey there, everybody, and welcome to another episode of Retirement Rescue Radio. I'm your host, Nate Miller, and today we're going to go over the new Secure Act 2.0 and everything that's in there. Okay, not everything. So there's over 100 things that are in there, and I went through there and highlighted some of them that I felt were either interesting, others that I felt would make a pretty big impact, and a couple other ones that I just thought were really cool that may not necessarily affect a ton of my clients, but I just thought it was really cool because it's going to be a really good thing for like specific niches of people. So to start off, one of the big ones that everybody I think knows about is the increase in age for the beginning date for your required minimum distributions. So some of you may remember when it used to be 70 and a half. If you've got money in a 401k, 403b, IRA, or anything like that, you had to start taking money out of it at a certain percentage once you reached age 70 and a half. That got moved to 72 with the Secure Act and is getting moved to 73 starting January 1 of 2023. So by the time this comes out, that's already going to have happened. And so now the required minimum distribution age for 2023 will be 73. And it's going to increase further to age 75 starting January 1 of 2033. So they're giving us 10 years now to increase it up to 75. So that's a big one right there. So those of you that we're doing any type of Roth conversions before you hit your required minimum distribution age, we've got more time to do that now. So that's great. Next, we've got indexing the IRA catch-up limit. So under current law, the limit on IRA contributions is only increased by $1,000 over the normal amount, and it's not indexed. And right now, once you hit age 50, they're going to start indexing that, but that's not going to start until basically after December 31st, 2023. So that's going to go into effect in 2024. So starting in 2024, they're going to index that $1,000 catch-up. Not only that, they are giving higher catch-up limits to apply once you hit ages 60, 61, 62, 63. So under current law, employees that have attained age 50 are permitted to make catch-up contributions under any type of retirement plan in excess of the otherwise limit, the limit they already have, right? And the limit on catch-up contributions for 2021, it was $6,500, except in the case of simple plans, which was only $3,000. But it's Section 109 of the Secure Act 2.0 increases those limits to the greater of $10,000 or 50% more than the regular catch-up amount in 2025. So yeah, well, again, this doesn't come into effect until 2025. And yeah, their increased amounts are indexed for inflation also after 2025. So that's a big thing that happened here is all the catch-up contributions are now going to start being indexed for inflation. So that's good. Next, special rules for certain distributions from long-term care qualified tuition programs. So this is, I think, getting a lot of headlines as well, because this is where the 529s can now be rolled over to a Roth IRA. However, it's not as good as I would have originally hoped. So what I've had a lot of clients, they've had 529 plans that they set up for either their kids or their grandkids, and now they're all gone and when I say gone, they're all out of school, didn't use all of it, didn't need all of it, whatever the case may be, they still have money in these 529 plans. And they're thinking, well, we might as well just take it out and, live off of it or whatever, use it for some retirement income. I mean, you can always change the beneficiaries if you want to different grandkids, but like if your grandkids are already past the age, you might as well get some benefit from it, right? So it would have been nice if this would have allowed them to roll over the 529 plans to their own Roth IRAs, but that's not actually how this works. It's Section 126 of the Secure Act 2.0. It allows for the tax and penalty-free rollovers from 529 accounts to Roth IRAs for the beneficiary of that 529 plan. So the beneficiary would be the kid or grandkid that you set it up for. That's the beneficiary of it. And so the beneficiaries of the 529 college plans would be permitted to roll over up to $35,000 over the course of their lifetime from any 529 account in their name to their Roth IRA. And those rollovers are also subject to Roth IRA annual contribution limits. So that means you couldn't roll over the whole $35,000 in 1 year. You'd have to roll it over in multiple years. Right now, if you're under, I believe it's 6,000, 6,500 or whatever for 2022 that you can roll over or that you can contribute to a Roth. So it's got that. Now, another couple stipulations here. So they are subject to the annual Roth IRA contribution limits, and the 529 account must have been open for more than 15 years. If you've already gone through all your kids and grandkids schooling, that's probably not going to be an issue. It's probably going to have been open for over 15 years, but that's another stipulation there. And so the 35, my opinion of this is it's going the right direction, but it's still not good enough, right? Because it's not the kids that set this up and funded it and that wanted to use it. It was the parents or the grandparents that set this up, and they're still not going to be able to get to use it. Now, if you still want to gift stuff to your kids, then absolutely, this at least offers that type of benefit, but it doesn't offer the benefit for the actual person who funded the 529 plan. So I think that I would like to see a Secure Act 3.0 or whatever down the road that took that another step further and gave us the choice. You could either gift it to your kids or grandkids over those annual Roth IRA contribution limits, which honestly, my opinion of that little stipulation in there as well is a little ridiculous. Just let them have it. You don't need to just let them have it over several different years. Just let them have it, right? So I would like to see them expand this to where the actual person who set up the 529 plan can roll it over to their own Roth IRA and use that for retirement income. That would be, in my opinion, how this section would have been way better. Let's see here. Next, they've also got some emergency savings accounts that are linked to individual account plans. So let me explain this one and then go through why. So individuals can save on their own, right? They definitely can do that, but far too many fail to do so. And there was a report by the Federal Reserve that almost half of Americans out there right now would struggle to cover an unexpected $400 expense. $400, right? And so many are forced to tap into their retirement savings if something like that happens. And a recent study found that in the past year, almost 60% of retirement account participants who lack emergency savings did actually tap into their long-term savings, compared to only 9% of those who had at least a month of emergency savings on hand. And so separating emergency savings from one's retirement savings accounts will provide participants a better understanding that one account is for short-term emergency needs and the other is for long-term retirement savings. So that empowers the employees to be able to handle unexpected financial shocks without jeopardizing their long-term financial security in retirement through some type of emergency hardship withdrawal. So what this is really doing is it's going to provide employers the option to offer their non-highly compensated employees some type of a pension-linked emergency savings account. And it'll automatically opt employees into these accounts at no more than 3% of their salary. And the portion of an account attributable to the employee's contribution is going to be capped at $2,500, or if it, lower if set by the employer, but $2,500 is the cap according to the law here. Once the cap is reached, the additional contributions then can be directed to the employee's either Roth defined contribution plan if they have one, or stopped until the balance attributable to the contributions falls below the cap. So the contributions are made into the savings account on a Roth-like basis. So they're not tax deductible. They're elective deferrals for the purpose of retirement matching contributions. And the match is set at $2,500, or like I said, lower if set lower by the plan sponsor. And the first 4 withdrawals from the account each year from the plan may not be subject to any fees or charges solely based on the basis of such withdrawals. And so they're setting up a savings account within the employer-sponsored retirement plan that they can access without penalties. That's really what they're doing, is they're forcing, instead of it being a savings account at the bank, they're forcing them to have some type of savings within the retirement plan itself. So that's really what they're doing with that one. That was a long and lengthy explanation to summarize that right there. Here's something that it didn't, when it first came out, something called a QLAC. It's a qualifying longevity annuity contract. And when they first came out, there was a lot more hype about them, and they just never really took flight. And so it was actually in 2014, the Treasury Department published final regulations on qualifying longevity annuity contracts. Now, we call them QLACs, QLAC, just QLAC. So I'm just going to call it a QLAC. They're deferred annuities that begin payment towards the end, really, of an individual's life expectancy. And because the payments start so late, these QLACs were an inexpensive way for retirees to hedge the risk of outliving their savings in defined contribution plans like IRAs and stuff like that. However, what they did, the amount that you put in that QLAC is now no longer factored into your required minimum distribution amount. So you basically just took whatever amount that was, and you no longer have to pay any RMDs, take out any RMDs on that amount. So that was great. And then it would defer you of having to take out that money until close to your life expectancy. And so it basically said, all right, you have, let's say, $500,000. And if you were able to put $100,000 into a QLAC, now your required minimum distribution is only factored on $400,000. That's basically what that means. And so the problem was, due to a lack of statutory authority to provide a full exemption, the regulations impose certain limits on the exemption that have really prevented QLACs from achieving their intended purpose in providing longevity protection. So the limitations were, and they've been repealed right now. There was a 25% limit, and the maximum was only $125,000 that you could put into QLACs. And so if somebody has $1 million sitting in their 401k or IRA accounts, and they wanted to defer that, so maybe they've got a pension as well. So they're like, you know what, I don't need all these required minimum distributions, but I got to take them out and pay tax on it. And so the QLAC was supposed to be set up as a way to avoid paying all those extra taxes. But they put the limits on there to where it was only 25% of your total balance up to like $125,000. Well, now they're allowing up to $200,000 to be used from an account balance to purchase a QLAC. And also that's going to be indexed. So it's going to start at 200,000, but it's going to go up every single year. And it looks like that is starting QLACs or spousal survivor rights clarifies free to look. Sorry, I'm reading it right here. It's effective for contracts purchased or received in an exchange on the date of the enactment of this act. So as soon as the act, goes through, bam, then it's going to happen. So we don't have to wait until 2024 or 2025 or anything like that. So that is also good. I'd still like to see them increase that a little bit more. But I mean, I know why they're not, because if they increase it too much, then they're not going to get as much tax. And there you go. All right. So this is a interesting one, and I'm glad they corrected it. It's a recovery of retirement plan overpayments. Now, this might not affect a lot of my clients that are already retired, but this is while people are contributing to their retirement plans, is sometimes retirees mistakenly receive more money than they're owed under the retirement plans. I guess that's good. Sorry. So it's like, hey, we paid you too much money, and we just now noticed it. You owe us XYZ amount, right? That's horrible. So especially when an overpayment has lasted for years from a pension, right? Plans often compel the retirees to repay the amount of the overpayment plus interest, which can be pretty substantial if it's been going on for years. And even small overpayment amounts can create a hardship for a retiree living on a fixed income. And so this actually allows retirement plans the latitude to decide not to recoup the overpayments that were mistakenly made to retirees. So apparently the law said if they overpaid them, they had to recoup those. And so now they're saying they can decide not to if they want to. If the plan does choose to still recoup the overpayments, there are limitations and protections applied to safeguard the innocent retirees. And that protects both the benefits of future retirees and the benefit of current retirees. And so that's the big issue, I guess, because they overpaid. So that means that now there's less benefits that are available for their other plan participants. So that's the big issue there. But now they can decide whether or not they're going to have to recoup those overpayments. So that's good. Let's see here. Oh, reduction in that extra penalty on qualified retirement plans. So this reduces the penalty for failure to take your required minimum distribution. So if those of you that don't know, that required minimum distribution when you reach 72, well, now they've moved it to 73. If you did not take that required minimum distribution, you were going to be penalized 50%. That's 50% of the amount you should have taken out. Plus, you still have to pay tax on that amount as well. And that's a huge, hefty fine, right? And what they're doing now is they're actually removing the 50% and lowering it down to 25%. So they're cutting it in half. That's awesome. Further, if a failure to take the required minimum distribution from an IRA is corrected in a timely manner, the excise tax on the failure is further reduced from 25% to 10%. However, there is the possibility that if you decide to, if you notice that you made the mistake and then you decide to take your required minimum distribution, you can write a letter to the IRS explaining what happened and what caused you to miss the RMDs and request for some type of forgiveness of that penalty. We've done that with a few people that when they came to us, their other advisor had given them bad advice based on, the multiple accounts they had, 403Bs, 401Ks, IRAs, and stuff like that. They were aggregating everything, and you can't do that. You can only aggregate IRAs. And so they were missing years of required minimum distribution. So we ended up taking the required minimum distribution, paid the tax on it that they missed for those several years, wrote some letters to the IRS. And the IRS basically says if you don't receive any news back or any communication back, it's pretty much going to be forgiven. So in this case, this is where no news is definitely good news. And so far, any of our clients that we've done that for have not received any correspondence from the IRS yet. So that's good. Still no news is good news. Here's a really cool one that I think could help a lot of people that may have, especially now. I know employees now change jobs a lot more than, say, a couple generations before us. And this is a retirement savings lost and found that's going to be created. So every year, thousands of people are approaching retirement, but they're unable to find and receive the benefits that they earned, often because the company they worked for may have moved, may have changed its name, may have merged with a different company. And similarly, every year there are employers around the country ready to pay benefits to retirees, but they're unable to find the retirees because the former employees may have changed their name, changed their address, whatever. And so this Section 303 creates a national online searchable lost and found database for Americans' retirement plans at the Department of Labor. And the database will enable retirement savers who might have lost track of their pensions or their 401ks to search for the contact information of their plan administrator. And it directs the creation of the database no later than 2 years after the date of the enactment of the act. So not going to happen right away, but within a couple of years, there should be some kind of a database set up to where we can search for some of our stuff and find lost money, basically. So yeah. And that happens, guys. I have sat down with several clients who didn't realize that they had a specific account somewhere, and we were able to find that. And so that is something that I think is really cool. Next, this one is not because I've got a ton of firefighter clients, but this is from my buddy Charlie. He's a firefighter here in Lawrence. And for those of you that may have read my book, he was up on the mountain with me during that incident that happened that I talk about in the last chapter of my book. And under current law right now, if an employee terminates employment after age 55 and takes a distribution from a retirement plan, the 10% early distribution tax or penalty is really what it is, does not apply if they're 55. So normally you have to wait until 59 and a half. But for firefighters, if you're 55 and you take a distribution, you don't have to pay that. However, there was a special rule for qualified public safety employees in governmental plans under which age 50 is substituted for 55 for purposes of the exception to that 10% penalty. And so this exemption is going to applied to public sector firefighters, but not private. So what this is doing is now it's extending the lower age 50 rule to private sector firefighters who merit the same treatment for the distributions. So there we go. So not only public sector, but now private sector firefighters have that age down to 50 that they can start getting distributions without the 10% early penalty. So that's pretty cool for firefighters. So Charlie, there you go. All right. Here's another one that I thought was good. It is a penalty-free withdrawal from retirement plans for individuals in the case of domestic abuse. Now, I don't have a whole lot of clients, at least actually, I have none that I can think of in my mind. But when you think of just like, I guess, percentages and how things work, that there's obviously some of them that may have been able to benefit from this at some point in their life. It's just not a conversation that we've actually, had. A domestic abuse survivor may need to access their money in a retirement account for a lot of different reasons to escape an unsafe situation. And what this allows is they can take out, it's either the lesser of $10,000 or 50% of their whole account. So 50% of the whole account, if they've got more than $20,000, 10% is the cap that they can do. And that's going to be indexed for inflation as well. And that's going to start in basically 2024 is when that one's going to start, after December 31st of 2023. So yeah, that was a good one there. And here is one that I hope so badly that this goes through and is to the level that I think it should be. It says, it's section 324, requires the Treasury Secretary to simplify and standardize the rollover process by issuing sample forms for direct rollovers that may be used by both the incoming and the outgoing retirement plan or IRA. And development and release of these sample forms must be completed no later than January 1st, 2025. So this is where I have a joke a lot of times, because transfer companies, 401ks, 403bs, IRAs, 457s, all these different companies and retirement plans, they all have different ways of transferring the money. There's no one uniform way that all these companies require you to transfer money. Some of them you have to fill out like actual paperwork to get sent in. Some of them you can just make a phone call and get it sent in. Some of them will be able to email you those documents. Some of them have to snail mail you to it, or them to you. And if you don't complete them by a certain amount of time, those forms are now obsolete and you have to have all new ones sent. And so there's so, and some of them will send a check directly to the income or the receiving company. Some of them will send it to the retiree. So then they have to forward it on, or some will just transfer it directly. It's like, and all the, yeah, so it's a headache. I have a joke where I say sometimes moving the money is actually harder than managing the money. And there was even more regulation that came out February of 2022 that made that even more difficult. What this is doing is says it is that standard sample forms for direct rollers that may be used in those. So that's going to be completed. They're supposed to have that completed no later than January 1st of 2025. So hopefully that will create some type of uniformity for all these different plans to follow for the direct rollover process. And the direct rollover basically means from institution to institution. That's a direct rollover. So yes, I hope for not only for the headaches for the retirees, but even my staff. I mean, some of that stuff, it's a headache having to go through all that stuff. And so many of our clients have said, well, I'm so glad that we had somebody to help us through that, because sometimes the language they use, it's a different language, right? And it's just, yeah, it's kind of, it can be anxiety inducing in my opinion. All right. Next, we've got some Roth plan distribution rules. Under the current law, required minimum distributions are not required to begin prior to the death of someone that owns a Roth IRA. So meaning you don't have to take required minimum distributions on your own Roth IRA. However, once you pass away and so your kids get your Roth, they do have to have distributions. Right now it's, in 10 years. And however, that's a Roth IRA. Pre-death distributions are required in the case of the owner of a Roth designated account at an employer plan, say a Roth 401k. So you did not have required minimum distributions for a Roth IRA, but we did with the Roth 401k. And Section 325 actually eliminates that. So there we go. No more required minimum distributions on Roth 401ks either. And well, maybe one or two more guys. I just put this one on because I think it's funny because it just shows that the government's just a little late to the game. So we've had some record high inflation in the last couple of years. And this directs the Department of Labor Secretary in consultation with the Treasury Secretary to study the impact of inflation on retirement savings and submit a report to Congress within 90 days on the findings of the study. It doesn't say how long they have to finish the study. It just says once they're done with the study, 90 days after that, they need to submit that report to Congress. So, I mean, guys, there have been studies, academic studies on inflation's effect on retirement all over the place. And so they're like, hey, it's record high inflation. We should probably study the effects of inflation on retirement. Yeah, a little late to the game, guys. And you can just cite other stuff that's been done in the past. So anyway, but as a whole, I actually like this. This Secure Act 2.0, I don't think there's not any one thing that's part of this that I feel is having as big of an impact as what the first Secure Act had. But when you add them all together, there are some pretty huge changes. So as a whole, I'm actually a fan of this. It's not bad. So glad this is able to go through. Love moving the RMD age back. Love the online searchable database for retirement plans. Love the fact that they might be getting some more uniformity to the whole transfer process within a couple years. I'm just biding my time now for those couple years. But yeah, so ultimately, I think some good stuff that came out of this. And as always, we're going to be continuing to monitor all of these different changes and getting information out to you guys as more of it unfolds on how some of this can be used, on how some of this might actually be, I want to say, unintended consequences. There's always unintended consequences of any type of legislation that goes through. So we'll keep you up to date on any of those that we may find as well, because we're always wanting to bring enough information to you guys so that we can empower you to live the retirement you deserve. And if you have any questions on how some of this might affect your retirement, click the link, 15-minute phone call with us. And from there, we'll decide whether or not we need to go a little bit deeper and if there's anything that we can do to help your retirement situation. So that's it, guys. We're looking forward to a better 2023 than a 2022. Again, it's not going to be a straight shot. I will have some updates on that, on what we think is going to be happening going forward in 2023. And then at the end of 2023, you can pull up that episode again and find out whether or not I was right. So that's it, guys. Have a great, I guess, next couple of weeks here, and we'll see you on the other side.